So if you've spent any time learning about real estate investing, you may have heard of something called a 1031 exchange. A 1031 exchange allows you to postpone paying tax on the financial gain resulting from the sale of business or investment property if you reinvest the proceeds in similar property as part of a qualifying like-kind exchange within the allowable time frame. What the hell does that mean? Well, hang with me, and I will not only explain it, but I will take you through a 1031 exchange step by step. I'm Carol Ann Reed with The Real Deal, where we give you the confidence and the clarity that you need to make the right real estate decisions for you. Do me a favor, if you like this kind of content, go right down below and hit the subscribe button so you don't miss any future videos. All right, a 1031 exchange. Here's the super simple version. You sell an investment property. Any profits that you realize get sent to an intermediary person who holds those for you. You go find a new property to buy. The intermediary transfers the profits from the one that you sold to the one that you're buying at closing, and you buy that new property. Sound a little too easy? It is. We are dealing with the IRS, so yes, it's way more complicated than that. So there's things that you need to know before you make a decision whether this is something that will work for you. So here's the easy definition. It is the swap of one investment property for another investment property that allows any taxes on your profits to be deferred. 1031 exchange comes from Section 1031 of the IRS tax code that incentivizes investors to stay in the game by allowing them to defer any capital gains taxes that they may incur by realizing a profit from the sale of an investment property by rolling it into another investment property. Now, why might you want to do this? Well, there are a couple different reasons. Number one, it allows you to buy up. So if you see $100,000 profit in the sale of a rental that you had, well, instead of the government taking a third of that, and now you only have 2/3 left to roll into the next one because you want to get something bigger, this way you keep that third that the government would usually take, and so you will qualify more or have a bigger down payment to buy something bigger. So you can keep expanding your investment portfolio. And the third reason has to do with depreciation. Now, I am so not a tax expert, and I highly recommend that if you're thinking about this whole thing, that you go consult a tax expert. But depreciation has to do, simple version, with how you value your assets. The government allows you to devalue your assets every year, so you're not paying taxes on the full value, and that gives you a little bit of gain as you go through the years. That's great for equipment because the value of equipment generally goes down every year that you own it. Your car is not worth the same amount this year as it was last year. However, with real estate, oftentimes the opposite is true. Real estate appreciates in value. So if you've been paying taxes on less and less and less value, but your value is actually going up, by the time you get there, by the time that you get to the point that you want to sell it, there is a huge difference in the value. So you are going to end up paying taxes on that. And that is called recaptured depreciation. And that can actually add up to quite a bit. And it resets that depreciation clock because you depreciate it over time. And so time is always ticking. But if you stop and sell one property and buy another, that depreciation clock goes back to zero. So just like every other government program, there are rules. So here are some basic rules. It must be an investment property. The two properties that you're swapping out, they must be like kind. Now, this is a pretty broad rule. It's real estate to real estate. So you can go from an apartment building to a strip mall. You can go from a rental house to a fourplex. As long as it's real estate to real estate, you're good. You just can't go from like real estate to art, to a completely different kind of asset. Your new property must be equal or greater in value, and the mortgage must also be equal to or greater in value. Now, if one of those last two things is not true, if the new property doesn't cost as much as you got for the old property, or if the mortgage isn't as high because you've got a bigger down payment or whatever, that gain that you get is called a boot. If it's profit on the sale, then it's called a cash boot. If the mortgage isn't as big, it's called a mortgage boot. Either way, you want to avoid that. And there are some basic options that you have, different ways that you can actually do this. Now, the most basic way to do this is called a delayed exchange. Very simple. You sell your investment property, you go find a new one, and you buy the new one. Or you can build to suit. Let's just say that you want to have something built for you. You can do that as well. The third basic way to do this is called a reverse exchange. And that is when you found the property that you want to invest in before you had a chance to sell the other one. You can do that. So why would somebody go through all this trouble to do this exchange? What value does it have? So let's go through a really quick example. And this is going to be super simple numbers, but it'll give you an idea of the power of this tool that we have as investors. Let's just say you bought a rental property for $100,000. And 5 years later, the market has been great. You threw in some renovations, you sell it for $200,000. So you have a profit sitting there of $100,000. Well, without this exchange, you know the government's going to want its take. It is going to tax you capital gains tax on that $100,000 profit that you made. Plus, the states get involved with income tax as well. So there's a state number on there. And if in Minnesota, it's 9 something percent. In California, it's 13 something percent. So let's just say your capital gains is 20% and your state tax, let's say you're in California, is another 13%. That is 33% tax on that $100,000. So you are only walking away with $67,000 of your $100,000. And if you want to roll that into another property, so let's say that was the plan all along, you found something else you want to buy, you have a lot less money to roll into that next project. 1031 exchange takes away that tax burden, so you can roll the full $100,000 into that next property. That means you've got like 33% more funds to roll into that next project. $33,000 in our example. Put it in as a down payment, or just that much more that you qualify for. That's a huge amount of money. And if you do that over and over again, your gains will start getting bigger and bigger and bigger. Very, very powerful investment tool. Okay, so let's just say you made it this far and you're thinking, whoa, this is really cool. I think I need to do this. Well, let me go through the steps one by one so we can work in some of these rules and things that you need to know before you dive in headlong. And again, I say go consult a tax professional. They're going to be way better at this than I am. But so you have some knowledge going into that tax professional's office, let's go through this step by step. Step number 1, go hit the like button below. Step number 2, if this is a delayed exchange, the easy one. First, sell your property. Second, you will need to find yourself a qualified intermediary. And you can get referrals from either your title company that you use or your most likely your tax professional. Either one of those two people should have names for you of qualified intermediaries that will work for you. So once you sell that property, that profit goes and is transferred to the qualified intermediary to hold for you, kind of in escrow, until you buy that next property. The profit never goes through your hands. That's the only way that this works, is you don't get to touch it. It goes to the intermediary to hold onto until you can get the next property. The next step is to identify your next property to the qualified intermediary. Now, there's a couple different ways that you have to report this to the qualified intermediary. The first one is called the 3 property rule. Go find 3 properties that you want to buy. It's just that simple, and show them all to the qualified intermediary. The second one is the 200% rule. That is when you can go out and find as many properties as you want, but all of them together cannot add up to more than 200% of the sale price of the one that you just sold. And the third way is the 95% rule. So if the first two didn't work for you, then go with the 95% rule and you'll still be okay. This is when you look at as many properties as you want, but it has to be the one that you buy has to be at least 95% of the aggregate fair market value of the properties that you have looked at. I know this is way deep in the weeds. Thank God for tax professionals. Okay, so you have found a new property you want to buy. You put in a purchase agreement. Your offer is accepted. You then talk to your qualified intermediary, and at closing or right before closing, that qualified intermediary will transfer those profit funds from their account to the closing, and at closing table, those funds will be there, and you then close on that new property. Now, 2 little bits of detail that are very, very, very important. Number 1, when you in the process of identifying that new property, you have 45 days from the date that you closed on the sale of your first property. You have 45 days to identify new properties. And then you have 180 days from the day that you closed on the sale of your first property till you close on your new property. There's 180 days. That is calendar days. It includes weekends and holidays and everything. You have to make sure that you hit those timelines or you could be disqualified. But if you are still working on getting your first property, either personal or investment, go ahead and take a look at this video, which will give you some information on getting a conventional loan for 5% down. I hope you guys enjoyed this video, and I'll see you in the next one.